$60 billion is the largest oil and gas merger since Shell bought BG Group almost a decade ago. And it's no coincidence that the Permian is the focus of this deal. The Permian is widely regarded as one of the most prolific and economically attractive basins, certainly outside the Middle East and arguably in the world. And look, in the last 5 years, and particularly in the post-COVID era, what we've seen is oil and gas companies do not drill at the rate that they used to. Capital discipline right now is truly the name of the game. So in that context, the way to grow is through M&A in many cases. And, we've seen plenty of deals in the last 3 to 4 years on a smaller scale, but this is one for the record books.
But for the Exxon shareholders as well, from what I understand, Pioneer is sitting on probably one of the best levels of inventory out of a lot of those independent or, mid-major names in the Permian. So for the price that, Exxon is paying for the potential that their fields do have, whether, they've already drilled in them or the ones that are ripe for getting drilled, is this, in your mind, good value, and should Exxon shareholders be pleased today with this resolution?
Well, it's a much lower multiple than what we would have seen if we had this conversation, pre-COVID, 5 years ago, certainly 10 or 15 years ago. 6 times EBITDA for, assets that, there was a time not that long ago when, they would be trading at 10 times EBITDA or even more. That really speaks to the decline in valuations across the oil and gas industry. It applies to the upstream, it applies to the pipes, it applies to refining, across the board. So it's a good deal for Exxon from a historical valuation perspective. Of course, at the same time, let's recognize that Exxon's own stock is trading at a much lower valuation than it used to historically.